Hey, what's going on YouTube? Welcome to my channel called London Business as Usual, where I teach new LLCs, new small business owners how to start, how to grow, and how to scale their business by leveraging their business credit. Now, today's episode, we're going to talk about bank credit, how you can use bank credit to secure funding for your small business. Now, if it's your first time on my YouTube channel, make sure you like, make sure you subscribe, make sure you hit that notification bell for future content. So let's get right into it. What is bank credit? So if you don't know, bank credit is totally different than building business credit and business funding. These are three different concepts. If you go back and watch my previous video, I talk about business funding. I talk about business credit. Now I want to talk about bank credit because bank credit is more credible in the eyes of these lenders. So let's break that down. What is bank credit? Well, first, bank credit consists of three major key components, and we're going to break these three major key components down. So the first major key component when you're dealing with bank credit is your bank history of your business bank account. That's the first key component, right? Having a business bank account and its history. So we want to make sure that we have that when we're talking about building bank credit. Now, business bank account. I really want to unpack that. Did you know most lenders do not consider you an established business, do not take you seriously unless you have a business checking account. So having a business checking account is properly structuring your business. So if you hear me all the time talking about having a fundable foundation, that means did you properly structure your business, which consists of having an LLC, EIN number, virtual office if you don't have a brick and mortar, listed in 411, being on Google, having a website, having an EIN, Dun and Brad, all these things to properly structure your business, to make sure that when these lenders look you up, that you're not looking at a high risk, you're not listed as a high risk business, or you're not listed as being fraudulent. Most of you guys get turned down when it comes to business credit applications because unverifiable and misinterpret information when it comes to your business credit profile, meaning your business information do not match up. So in order for you to properly structure your business, especially when you open up a business checking account, your information have to match, which means your business name, your business address has to be the same that's on your Secretary of State, the state that you filed in, your LLC or corporation or S corp. Also, when you go to the I, the R, and the S, you go to their website and you get that EIN, that information has to be the same. So all the information has to match what you put on that business, on not only credit application, but also when you go get a business checking account. Make sure that your business name is exactly what's on your LLC or what's on your S corp, whatever entity you create, and make sure that your business address matches too as well. So all that has to be the same. It's called congruency. Everything has to match in order for you to even pass their AI system as far as getting qualified for business credit, let alone open up a business checking account. So that's the importance of having a business checking account. That information has to match. And also, most lenders do not consider you being in business unless you have a business checking account. So let's say you've been in business for 2 years. You've been doing your thing for 2 years and you just got incorporated last year. So now on paper, you filed with the Secretary of State a year ago, but you still did not have a business checking account. Let's say you just got that 3 months ago. Well, did you know to most lenders, you're now established as a business owner only for 3 months because you never had a business checking account. So we definitely want to make sure that we have a business checking account, but we have to properly structure our business, right? That's having that fundable foundation. Now, after we do that, next we want to focus on our business account history. How long have we had our business account? Longevity matters. Did you have your business account 6 months? Have you have your business account 12 months? Have you have your business account 24 months or more? So the reason why this is important is because lenders want to see how long have you established a relationship with a bank, which is really important. So open a business checking account and do not close it. Open a business checking account and do not close it. I have to repeat it because a lot of people open a business checking account, then they decide to close it for some inexplicable reason. I don't know why, but Most of you out there do. Keep your business checking account open because you're building a long-term relationship. And I'm going to talk about why that's important in a second. So that's the first key component. Your business checking account and its history. You want to establish that. Now, component number 2 is the most important key component, is your bank rating. This is your bank rating. So your bank rating consists of 3 major components, 3 major factors when it comes to your bank rating. Let's talk about factor number 1. Factor number 1 is your bank rating number. So let me put this in perspective. So your bank rating number, your bank credit has nothing to do with your personal credit, or it has nothing to do with your business credit. Again, these are 3 different concepts. So we don't focus on your personal credit. We don't focus on your business credit when we're dealing with bank credit. Just want to make that clear. Now, going back to your bank rating number. Your bank rating number consists of 3 major factors. Factor number 1, right? How do you manage your cash flow, as far as how often or on a consistent basis do you have positive cash flow? Are you able to pay your expenses? Are you able to pay your debt and have a positive cash flow? This is part of your bank rating. All right, so let's unpack this. Let's break that down. So for all of you out there who average, let's say you average under $1,000 in the last 3 months in your business, because all your bank rate number is how much do you average in the last 3 billing cycles. So basically a quarter. So let's say, just throwing numbers out there, you $500 one month, $600 next month, and $800 or $300, whatever, in the third month. So in 3 months, you average less than $1,000. Now we get into your bank rating number, which means you have anywhere between a low 3, low 4, low 3, mid 3, and a high 3. If you average less than $1,000 in the last 3 months. That's really important. So if you average less than $1,000 in the last 3 months, you have a bank rating. It's just in the 3s, right? It's in the 3s. Because if you have a low bank rate and that's in the 3s, you definitely need to upgrade. So I'm not going to talk much about your bank rating number in the low 3s. Now, once you scale up, let's say you averaging $1,000 in a month. So in the last 3 months, you average $1,000. So that's your bank rate number. You take your last 3 bank statements, you add those together, and you divide it by 3, you get your bank rate number. So what that means is if you're averaging $1,000, now you upgrade it. Now you have a low 4. Anywhere between $1,000 to $3,999 is the bank rating of a low 4. Now, once you upgrade, let's say you have a mid-level 4, now you upgrade. So now you average anywhere between $4,000 all the way to $6,999. So if you average that amount in your business checking account, that's going to be your bank rating for that. I'm going to tell you what's your good bank rating in a minute. Now, let's say you upgrade it. If you have an average of, let's say, a high 4, you're going to have anywhere between $7,000 all the way through $9,999. Now you have a high 4. So $7,000 all the way to $9,999 is considered a high 4. Now, are those numbers good in the eyes of the lender? Technically, no, because lenders want you to have anywhere between a low 5 or higher. So let's break down what is a low 5 bank rating number. Low 5 bank rating consists of $10,000. This is average on a monthly basis in the last 3 months. $10,000 all the way to $39,999. That's considered a low 5 bank rating. In the eyes of a lender, they love to see a low 5 or higher. So you want to make sure that you average $10,000 or more in your business checking account. Some of you are like, oh man, that's almost impossible. I'm just starting out. That's fine, because there are ways around that. Look, if you understand the banking system, you can easily manipulate the system. This is what I'm trying to tell you. So just stick with me. So now if you go higher than that, let's say you average $40,000 all the way to $69,999. Now here you have a a bank rating of what was I on 5? Oh, of a mid 5. So now if you want to go higher than that, so now you're saying, hey, if I get a high 5 bank rating, what does that look like? Well, that's $70,000 all the way to $99,999. That's a bank rating of high 5, right? So there you get $100,000, you go higher. So you get what I'm saying. So that's your bank rating number. So now you have to determine what is your bank rating number. And that's going to determine whether or not you get a loan or not. So remember, this have nothing to do with your personal credit or your business credit. This is strictly going off your bank credit, which is more powerful than business credit. Now, that's the second key component when it comes to your building bank credit, right? So remember, now I'm breaking down your bank rating, what consists of your bank rating. So if you go to your bank rating cycle, which means when your bank rating cycle, that's going back to the 3 months. So you can't have this money in there for just 1 month. So let's say you have $10,000 in your business checking account for 1 month and you think, oh, I'm good to go. Let me go get a bank line. No, because they're going to go back another 2 months and see exactly what that number looks like. So you want to make sure your bank rating cycle consists of 3 months. That tells them everything. So they go back quarterly. Last 3 months, what is that bank rating number? So your bank rating cycle is really important too. Now, the third factor when it comes to your bank rating number is how you manage your business checking account. This is really important because if you have non-sufficient funds, NSF, in your business checking account, that's like immediately a turn down. Remember, when we're dealing with bank credit, we're talking about your ability to pay them back. Banks only care about 2 things, your willingness, and that's based on your business credit profile, your personal credit profile. Then when you're talking about your bank credit, which is your ability, when you're talking about your money, how much money you're making in your business, that's predicated on your business checking account, aka your cash flow. Primarily, that's what we're talking about, your cash flow. So how do you manage your business checking account? Do you have non-sufficient funds? Right? So that determines whether or not you get qualified too. So we definitely want to make sure that we properly manage our business checking account, right? So those are the 3 factors that determines your bank rating number, right? Inside of building business credit. So the 3 key components again is your number 1, your business checking account and its history. Number 2, we just got to talk about your bank rating. Now the last 3 key component is building a relationship with the bank. Do you have their products? Do you have their services? Such as, I talk about this all the time, which is king. Do you have their business checking account? Do you have a personal account with them, a saving account with them, a secure business credit card, unsecured business credit card, secure loan, unsecured loan? Do you have a business lines of credit with them? Do you have a prepaid card? Do you have a merchant account? What do you have with this financial institution? That's building a trust. So if you build trust, meaning they know you, they like you, they trust you, now they're able to extend you business lines of credit or credit lines, whatever that you want with their financial institution, or you can qualify easier, I should say. So building a relationship with these banks is really important. That's a third key component that goes into building bank credit. So I hope we got that. So if you guys, personal credit is not in position, maybe you're brand new with building business credit, you can start with bank credit. Bank credit is a really powerful tool. Again, it's different than building business funding or even bank credit. If you have business funding or business credit, if you have a strong bank credit, your odds of getting qualified for funding or secure funding for your small business is really high. So thank you for tuning in. Make sure you like, make sure you subscribe. See you on this video.